Keith, I'll start with you. Fresh highs for both the NASDAQ and the S&P today. I mean, we did see a 3.5% pullback, a couple weeks ago now with the coronavirus concerns. But the fact that we continue to move to fresh highs, even as cases and fatalities climb, does it make sense for the markets right now? Is the worst over? Is it priced in?
Well, the first thing, this is certainly a serious humanitarian crisis by itself, so let's respect that. From a market perspective, really what we're seeing is that I think the market is giving the companies a pass as far as earnings. They know their earnings were going to get hit, but we've seen the 10-year Treasury come down from 1.9 to 1.5. The Fed now is more likely to cut rates as opposed to increase rates. And the equity risk premium has moved higher. So I think all in all, the market's taken this in stride. And I do think the long-term trend is still positive. I will just say, I think short-term, yes, we are at new highs. We're a little bit more mixed on our short-term view just because valuations are at cycle highs. The put-to-call ratios are at cycle lows, meaning no one's concerned about the downside. And I still think there are some uncertainties about the effect of this virus going forward.
Scott, your thoughts on the market right now?
Well, I mean, the market is certainly pricing in the coronavirus right now. It may not be very obvious when you look at just the headline S&P, but Keith pointed out that the 10-year bond coming down 30 or 40 basis points, and if you look underneath the S&P 500, the rotation that we've seen over the last 3 or 4 weeks is back to the kind of the defensive leadership stuff that we had for most of last year, frankly. So it's think of U.S. over international, growth over value, large cap over small cap, all by like 300 to 400 basis points over the last 3 or 4 weeks. Those are big numbers, and that's showing that the market is taking account of the virus. It may just not look like it when you look at the top line numbers.
Keith, what do you think are the most important forces in the market that are counterbalancing the COVID-19 coronavirus concerns, and how stable are they? Like, are there things that are causing investors to take heart and shrug off the virus, that if those things weaken, we could see a leg lower?
Sure. I think the big thing, especially from a U.S. market perspective, the amount that we export to China is still relatively low. And we're seeing the U.S. economy, recession risk is still relatively low. Look at the permit data today, new cycle highs. That's a long leading indicator. And also, as rates have come down, oil prices have come down, that's all good for the consumers. So I think this is a positive for U.S. markets. And we're still somewhat in this TINA market. There is no alternative. So that's buffering the downside. As far as things to look for, I think we're going to get a pass over the next month or so. But right now, earnings for this year are around 175 and starting to bleed lower. So if we start to see worse expectations, worse than what people are already pricing in, I think that's the risk for the market as we move towards March and April.
Scott, given the move we have seen in rates, Treasury yields in recent weeks, what is the bond market telling us right now?
Well, it's telling us that they're coming around to the idea that the bar for the Fed to hike rates over the next 3 to 4 years is almost impossibly high. I heard Torsten Stock on earlier with Santelli, and he was talking about the fact that they're having this rethink at the highest levels of the Fed. He's absolutely right. But that rethink at the highest levels of the Fed is really, I think, underappreciated by the market right now, because it's when they're rethinking how they actually measure inflation, that's a really big deal. And if they're going to measure inflation more on an average basis, that means that the past misses that we've seen over the last 5 or 10 years on the inflation side make the bar to raise rates actually really, really high. So the fact that we're having lower rates isn't really telling you that we're having a growth scare or anything like that. The lower, the drop in rates we've seen with the impact from the virus has been really almost exclusively due to the term premium. And that's just telling you that that's a bit of a flight to safety. And it's also the market coming to grips with the fact that the Fed, along with other central banks around the world, are just not raising rates anytime soon.